reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
A slightly cautious tone that the Asian markets are currently trading with, 0.7% lower on the Hang Seng.
Sending letters out on Monday having to do with the trade deals.
But they go into effect on August 1st. Tariffs go into effect August 1st.
It's going to be a little quietish as far as markets are concerned, so I don't expect any big moves, big fireworks in that sense. Support for the Nifty 25,165, 25,460. Absolutely flat. The Nifty Bank is down about 0.13%.
3 years is the start of production. So FY28, the aircraft will start rolling out.
100% of these are meant to be in the category of what we call indigenous design, development and manufacturing, IDDM.
Overall benchmark indices are markets largely range bound, but the quarterly updates are what are keeping the stock perked up and in some cases under quite a bit of pressure.
Well, a massive 2-point change on the Nifty is what you have. It's one of the...
Prashant, you started with massive? Oh, what have I missed? Was my screen
Should have given it a break. A massive... Keep quiet for 2 seconds, then go for it. Well, you know, it is one of those days. It's one of the quietest days we've had in a long, long while. 25,460 is what you have on the Nifty. Declines outnumber advances in the broader market. We'll get to all of that in just a bit. We are coming to you from the CNBC-TV18 Motilal Oswal studios. This is Closing Bell. I'm Prashant. With me, my colleague Surabhi, Reema in the studios. Nigel is joining us from the newsroom floor. Guys, good afternoon.
Hi. Afternoon. 6.
Oh, look at that, matching in shades of pink. Market may be in pink of health or not, we don't know, but yeah, we have a nice pink here.
No, absolutely. Nice pink here and maybe a little red as well, right?
Yeah, we got some red.
On the redder side.
Yeah, the reality check.
I think, but you know, it's a market. I mean, what do you say? Neither here nor there. Neither, and we put out very, very near-term levels in the morning, but it's so flat that it's not once gone to either the upper bound or the lower bound at all. Except maybe just one index, which is the FMCG index, which I think is going to be the focus over the next 15 minutes or so. Nimish will join us. Is something he alerted on Friday, and we will revisit that piece with him as we go along. But otherwise, that's the FMCG index, 1.5% higher. Otherwise, I mean, I think at least at the index level, you kind of sort of struggle to find action in that sense. You know, just one other thing, and this is something we alluded to in the morning as well. You know, with the, how do I put it? With Jane out of the way, with Jane out of play, is our market's going to be a little more boring? I think maybe the answer is yes. And when I say Jane, I'm using that firm as sort of like a placeholder for the category of funds, right? Jump and Citadel and Graviton and et cetera. So many of those, that category of players perhaps will be pulling back, have already pulled back. Those big spikes and big moves that we saw, especially on expiry days, perhaps, at least for now, a thing of the past. That's another thing to watch out for. But otherwise, for now, 25,452.
But you know, things have been quiet even while you were away. So the whole of last week, from Monday to Friday, markets were consolidating. And today marks the 6th consecutive session where markets, have been in just a holding pattern. It's just that today's trading band of about 80 points is less than the trading band that we had even in the prior few sessions. Sectorally, defense is seeing profit booking after last week's mega up move. BEL is your top Nifty loser, a cut of more than 2%. Some IT stocks, a skittish earnings season, which starts with TCS on Thursday evening, is not supposed to be great. 4 out of the 5 large Nifty IT companies are likely to report a degrowth in the current quarter. Tech Mahindra particularly is getting hit. Last week when Macquarie downgraded Tech Mahindra, and the analyst told us that Tech Mahindra is one of the most expensive IT stocks, now 30 times FY26. So that's the reason why you are seeing a bit of softness. ONGC, Hindalco, Maruti Suzuki are some of the other names where you are seeing cuts of about 1.5%. On the way up, it's all FMCG, HUL, Nestle, ITC. These are the top 3 gainers today, and Reliance Industries once again is moving up, and now Reliance's year-to-date up move stands at about 18%, so outperformance.
Yeah, that's pretty much where the green is coming in from. On FMCG, and FMCG is really the only story, the only game in town, so to speak, and we'll get in Nimesh to talk about this in just a bit as well. Jubilant is probably the only number, or the only stock that's reacting negatively to its update. Everything else is up. In fact, even Dabur, if you pull up the intraday chart of Dabur, it started a little soft in the morning because they're talking about the beverage portfolio still weighing on the company's Q1 performance. But then since then, it's recovered. It's managed to hold on to gains. By the way, must mark, though, that today the mid-cap market is falling a little more than the frontliners, which is a departure from last week. And we're seeing that play out in many, many stocks. For instance, Indus Tower is lower. Jubilant, I mentioned. A couple of other names like Info Edge as well. These are some of the names on the losers list. But Nigel, yeah, let's see. I mean, it's extremely quiet, at least as far as the headline index goes.
Well, when Prashant was talking about Jane, the song that came to mind was It's the Last Dance with Mary Jane.
Mary Jane.
Yeah, top Perry. All right. But interesting words, interesting meaning as well. But that for another day. Let's get to Mitesh. Mitesh, what are you making of today's trading action and what are the levels you're looking at?
So, Nigel, I think the action has been quiet, as has been for the past few days. The market is very slowly tapering off, but yet not giving a decisive breakdown below 25,400. We're just lingering around there. And my bet is that in case we break that, we might see another 200 points on the downside, but that's about it. So the index remains, more of contracting in nature, and therefore the index can be avoided. I think trading should be more focused on the stock side, and that's where traders will get at least some movement happening on stocks which are individually showing breakouts or breakdowns. I have a buy on Petronet with a stop at 301 for targets of around 315 to about 316 on the upside. And the other one which I like, that's a negative call on Shriram Finance with a stop at about 682 for targets of around 645.
Okay. All right. Got that, Mitesh. Thanks very much. We'll come back to you for some more trades and some ideas in just a bit. But now let's put the spotlight on the FMCG sector, which continues to really, run ahead. It's the top performing index on the street today. Remember, we had discussed this in Editors Roundtable itself. Nimesh, in fact, had flagged this off, saying the market is paying full attention to FMCG stocks and hoping that this time is going to be a real turnaround. So since, I remember that conversation on Friday, Nimesh, and clearly that's exactly the market's pulse. So why don't we revisit what your data had thrown up?
Well, Surbhi, so as you said, we discussed is the tide turning for FMCG sector, and that's exactly what I put out as a piece on Friday as well. I'll talk about the tailwinds which are likely to come up in the very near future. But first, the facts and the numbers. Actually, the FMCG sector and the stocks have massively underperformed in the last 5 years. If I have to tell you that, stocks like HUL and Dabur have given negative returns, and that's largely because they've struggled with growth amid various disruptions. But now look at the stock prices over the last 5 years. As I said, the likes of Dabur and HUL have given negative to flat returns over the last 5 years. This is a 5-year stock return CAGR for the FMCG basket. And that's also because the numbers have been quite disappointing or weak over the last 5 years. So something like a Dabur or a HUL has given just single-digit growth over the last 5 years, whether it's a revenue CAGR, operating profit CAGR, or PAT CAGR. Just single-digit, 4.8% for Dabur in terms of top-line growth, 6% for HUL. So that shows that the numbers have been quite weak for these companies in the last 5 years, and that's showing up in the stock prices as well. So this is the first bucket. There are some FMCG stocks which have delivered 10 to 15% returns over the last 5 years. Even in that context, it has massively underperformed the overall markets in the last 5 years as to what the Nifty, the Bank Nifty, others have done. Now, 10 to 12% return is what the likes of Colgate, Dabur, Britannia, United Breweries and Tata Consumers have given over the last 5 years. And even here, it's essentially the growth which has been missing for most of these companies. Even in this bucket, most of the companies have reported a single-digit growth, barring someone like a Tata Consumer. All have reported single-digit growth over the last 5 years CAGR. So that's the second bucket. The third bucket, which has actually done well in the FMCG pack, as we call, is the sin stocks, the likes of ITC, the likes of United Spirits, Radico Khaitan, Cupid, Titagar. All these companies have relatively outperformed. And look at the stock price movement between 15% all the way to 63%. And this is backed by fundamental numbers as well. Most of these companies in this particular bucket has actually reported very strong revenue and bottom line growth. Look at something like a Radico Khaitan, 10% revenue CAGR over the last 5 years. Godfrey Philippe, 18% revenue CAGR. So is the likes of Titagar up 17.5% revenue CAGR. And also the operating profit and profits have been quite strong for most of these companies, barring Global Spirit. So at least this is the space which has delivered in terms of numbers as well. Okay, so this is what the stocks have done in the last 5 years. But my whole piece was, are we seeing a bit of potential tailwinds for this sector? The first big tailwind is going to be the GST rate rationalizations. We've been reporting about, a government thinking on rationalizing the rates, and many of those, FMCG companies are still in the 28% bucket, and that's where the first hope is likely to come. The second is going to be the good monsoon. Already the signs have been quite strong that there is going to be a good monsoon, so that's a potential tailwind for the FMCG sectors in the second half. Similarly, this is the first time in 4 or 5 years that the government has shifted the focus in the budget from capex to consumption. So clearly the government is also now focusing towards consumption. And the last but not the least, the income tax cut was again aimed to boost consumption. And all this is going to get played out in the second half of this year. So that's the potential tailwinds for the sector. But I guess today's up move, Surabhi, is clearly on the fact that a lot of the Q1 updates have been quite strong from the likes of GCPL and Dabur, and hence we've seen a bit of an uptick. But finally, it looks like the tide could be turning for the FMCG sector.
Okay, absolutely. I mean, the market's interest is fully there. And if the companies manage to deliver, and some of them actually, to be honest, are delivering better commentary and slightly better numbers, at least the updates for the first quarter. Thank you so much for that, Nimesh. We are going to discuss this, further with our guests. In fact, Deepan Mehta of Elixir Equities is joining in. Deepan, good to have you on. Good afternoon. Massive moves in the market, as Prashant said. But on a quiet day like this, what do you make of the market's interest in the FMCG space? I mean, this is a market very hungry for new ideas. But do you think FMCG can indeed be anything more than a passing trade?
Good afternoon, Surabhi, and thank you for having me on your show. I think I'll go with the latter argument. It's more of a passing phase because there is a secular growth slowdown in the FMCG sector. A lot of categories have reached maturity phase. Their volume growths are now more or less in line with population growth, and the entire expansion of the volumes was through distribution network into the rural areas. Now all that is over and done with. So I think any significant rise is there in the FMCG stocks. It's a great opportunity for investors to get out of these companies. And I know for a fact that many investors are intergenerational investors in HUL, Colgate, Nestle, Godrej. So if these investors don't take this opportunity to exit out of these companies, then again, there'll be an opportunity lost, like what they saw in the last 5 years. You could have 3 months, 1 year of outperformance. But when you're looking at a portfolio, managing a portfolio for 5, 10, 15, 20 years, the next generation, you have to be avoiding the traditional FMCG stocks.
Okay, nothing even the traditional FMCG stocks you would avoid, but what about spirit makers? You've spoken in the past about United Spirits. Tilak Nagar has done exceedingly well, a Radico Khaitan. Would any of them be on the buying list?
So in our opinion, we are categorizing FMCG into 4 buckets. The traditional FMCG, and then there is new FMCG. And I would put that in that companies like Mama Earth, which is there. Then there is Nykaa over there. There is Zydus Wellness, which is interesting. And such select companies which are there, which are still into, there's Vadila Industries, ice cream maker, and Varun Beverages. So these are the new FMCG companies where there is still decent volume growth because those categories are underpenetrated. And they could still have that 15-20% top line growth, 10-12% volume growth. Then there are the dairy product companies. The likes of Hatsun is there, Parag Milk Food is there, and Heritage Foods are there. These are the companies which are actually into milk distribution, but they're moving up the value chain by getting into dairy products and branding them. And they have had some success over there. Particularly, we like the business of Parag Milk Food over there, usual disclosure. And then there are the Alcobev companies, which are also technically FMCG. But then they have various other challenges in terms of state-wise regulations, which do tend to cause volatility in earnings. But even within that space, our preference is for regional, homegrown, domestic Alcobev companies.
Okay, all right, got it. Deepan, just stay on. We want to discuss some of these defense themes with you as well, which have been very, very active. I mean, once again, the market's interest coming back because of this procurement of orders worth over 1 lakh crore rupees, which was announced last week India's Defence Secretary R.K. Singh spoke exclusively with us today. In fact, he was in conversation with Parikshit, and Parikshit gives us now the key highlights from the conversation ahead. Parikshit, so tell us, what were the big takeaways for you, and what's the overall sense you picked up?
The big headline from the R.K. Singh interview to CNBC-TV18 was the fact that the Defence Ministry is going to seek an increase in defence expenditure as a share of total GDP. In fact, the Defence Secretary said they will be seeking an increase in defence expenditure as a share of GDP from 1.9% to 2.5% in the next 5-year plan, and this request will go to the 16th Finance Commission. So the cycle that we're talking about is 2026-2031. When it comes to spending, defence spending in this fiscal, the Secretary said that the government may consider requesting for additional allocation within the revised estimates for this year because there are emergency procurements taking place, there are large-scale orders that the government is making, and they're well on course to spend over 2 lakh crores on acquisitions, procurements, and domestic manufacturing. So all of that may point towards the need for additional funds in this fiscal, but a call is yet to be taken. He said it's still too early to decide. On drones, the Operation Sindoor highlighted the need for combat drones, UAVs, early warning systems. He confirmed on record that the government will soon issue a large tender which will make sure that the industry does not need any financial support, and this will be for drones, swarm drones, and UAVs as well. On the 5th generation fighter program, our own AMCA program to build a homegrown 5th generation fighter, he said that an RFP has already been issued. There has been a pre-bid meeting that has taken place with the industry, and they hope to conclude the process of granting the contract in the next 3 to 6 months. This will have a gestation period of about 10 years before India's own 5th generation fighter could hit the skies. At the same time, India will look for acquiring 5th generation fighters from key partners. He did not name the partners. We asked him whether there are formal proposals from the US or Russia. He did not comment on that, but said conversations are ongoing and we cannot give a ball-by-ball commentary. At the same time, Rajnath Singh has recently taken up the issue of delays in procurements from the US, such as the 404 engine, which is very important for the Tejas fighter, the 414 program, which has been delayed as well, Apache helicopters. So he said that 3 Apache helicopters will be delivered by the US this month, and as far as 404 engines are concerned, 1 was delivered in April, 1 will be delivered in July, and thereafter 2 engines will be delivered for the Tejas every month till March next year, which is going to make HAL comfortable enough to deliver 12 Tejas fighters in this fiscal. Then when we speak about the F404 engine, which was supposed to be manufactured at an HAL line in India, the Secretary said that the technical part of the technology transfer, that is done, and the commercial negotiations around pricing may take another 2 to 3 months. So let's see how that goes. India and US are also holding price negotiations on P-8I aircraft. That will soon be concluded. India will be acquiring more Javelin missiles. There are talks for collaboration on Striker armored vehicle systems. And more importantly, a 10-year India-US defense roadmap will be signed later this year. So lots happening in the defense sector, but broadly, this is the focus of the government.
On the capex side, there's never been a constraint, actually. There has been a constraint in terms of our ability to actually fully utilize our budget. And we've done it last year, and we are well on the way this year of ensuring that our quarterly expenditure targets are met. So based on a faster pace of expenditure, we can ask for additional money during the revised estimate stage if it is felt that the requirements are more. So I would say that we are, it's likely that we might need additional allocations in the long run. For the 5-year cycle of the 16th Finance Commission, we are going to be seeking additional allocation to the extent that our defense share in the GDP goes up from the current figure of about 1.9 to about 2.5. So as far as we are concerned, yes, the nature of warfare changing the way it is. There is a large market for drones in the country, military drones. And I think industry recognizes that and is making investments. There are one or two promising companies with Indian designs as well. There are others, including some large industry conglomerates who've tied up with foreign vendors or OEMs with transfer of technology. So yes, from our side, the support will be there in the form of large orders, large RFPs or tenders that will be issued, and it will be under Indian, by Indian and IDDM categories, because the intent is to make it in India, but it could be at fully Indian design and manufactured. It could also be one where the technology is from outside, but the construction or the manufacturing takes place in India.
Well, we spoke with Mr. D.K. Sunil, the CMD of Hindustan Aeronautics, on the order book outlook. Let's listen in to what he had to tell us.
This will be a very big R&D effort for the Sukhoi 30, which will take about 5 years to complete. And 84 aircraft will be upgraded, and that will, production will, the overall and repair and the upgrade will pan out after 5 years. And it's expected to be about 65,000 crores. Helicopters will be built predominantly in Tumkuru. We already have started producing the LUH there. So the facilities are up, and that will be expanded to cater for the LCH also, which is the Prachand. So we expect to close it in 6 years from FY28 onwards.
Dipan, how excited are you about defense, and what is that stock that you still like given the kind of outlook? We know the runway is big, the problem is on valuations. So what's fitting the bill?
Yeah, it's just valuations. I was doing a quick check because we also have a complete screener on as far as defense stocks are concerned. The cheapest at 40 times is HAL. Be it private sector or public sector, the P multiples are just too daunting. And I understand that these businesses can grow at a very fine clip, some as fast as 50%, 40%, others also minimum 15, 17% or thereabout. But look, I think they're highly fancy. There's some amount of froth also, I feel, that's happening in these stocks. And it's better to just wait and watch. Don't sell existing holdings, that's what I feel. But wait and watch to make a fresh investment, especially if you're underweight defense. And that time will come when there is a kind of peace in the world and all these, geopolitical events, all these friction points are reduced. And when there is peace and there's, these news flow reduces as far as defense stocks are concerned, that's a good opportunity.
All right, Dipan, one more stock you had mentioned last time around was Orient Pro. You were saying that, it's looking like it's setting up well. I think from the time you highlighted the stock, I think around 10 days or so ago, the stock has gone up, gone up, I think 15%. Did you all get in, or are you all still evaluating it? Because today itself, it's moving up on very large volumes.
No, it was just a lucky call. We are not invested in the stock at all. We wish we had. And, again, I was just scanning through all the entire software stocks or the entire spectrum and just doing a simple analysis of where is the growth coming. And if you look at the entire spectrum, I think the growth has come from mid-cap, small-cap stocks like Orient Pro. Then you go deeper into the story, and it is very clear they're not a typical software services company, just doing application management, development, deployment. They're into products and platforms. And truly, that's the way ahead for Indian software industry. If you want to create wealth, you have to look for companies which are doing products and platforms. Could be B2B, could be B2C. That's the only way forward. The traditional software companies, the likes of TCS, Infosys, they have got great challenges and many issues around them. So I would avoid them. So in same light of that, this stock came up. I think it's a good story. But again, I think after 15% up move, it seems to be reasonably valued. Maybe look at buying it at correction.
Okay, no, absolutely. Dipan, we'll leave it there. Appreciate you joining in. Great conversation as always. Thank you very much. We'll take a quick commercial break here. We'll come back with Pashupati Advani on the other side. More market conversation coming up. Okay, but the market is down about 32 points, so not very much at all happening. It's absolutely flattish. General insurance numbers are flashing at the bottom of the screen, and we'll have Yash come up to explain, the company-wise details and put this in the context of what we've seen over the last couple of months. Maybe sort of look at, the data for June as compared to the, April onwards changes for some of these companies. Otherwise, 1,800 stocks lower, 1,000 and 1,100 stocks higher. It's the same old picture. Dream Folks is still down about 6%, so that's sinking one way. And it's lost quite a bit, 230, 240 rupees 4 days back, and stocks under 180 rupees at this point in time. Defense, of course, there are names like DCS, etc., which are higher, but you've got a few which are actually under pressure as well. Right now, Deepak Fertilizer down about 5%. Actually, lots of names and decent-sized volumes as well for this point in the day. Pashupati Advani is with us, founder and chairman at Global Foray. Pashupati, good to have you with us here. Thank you very much for your time. I don't know if you heard the piece that Nimesh put out on FMCG, but my question, of course, you can talk about FMCG if you'd like, but broadly the consumer name, which actually many on the street are also pushing as if, to say that its time has come. And then maybe, it'll start to do better. The latest kind of news which the market is excited about is potentially that GST slab realignment, that 12%. And how that perhaps gives another leg to consumption. We don't know if it'll happen or not, but the FM herself has spoken about this. What is your sense? Do you think one will make money in consumer names from here?
Well, consumer names, as you rightly mentioned, have been a bit blah over the last 6 months to a year, and that obviously is not been great news for the markets. They've kind of held in there, but again, consumer names tend to be bought in defensive markets. So I think we need some kind of move towards new investors being defensive. But in the meantime, they've not really sort of really performed fabulously. In fact, they've been kind of blah. But their time will come. I think obviously the cut in GST to 12% will be a big boost for them. And I think maybe they're just waiting for that.
Pashupati, hi, afternoon. Any new ideas, any new purchases that you guys have done?
Well, actually, what has been of concern has been the large number of IPOs that have come in terms of the volume. And I think that's basically weighing down the market. I have bought a couple of them around the offer price. Some of them are waiting for them to come back to the offer price, which I think will happen. Just because there seems to be about $7 or $8 billion worth of IPOs that have come in the last 30 to 45 days. So it's like a huge amount that the market has to absorb. And I think our market kind of gets driven by supply and demand, and there's been a lot of supply and a lot of PE people exiting and things like that. So that's not a healthy sign for the markets in general. It's showing that our markets are overvalued and people want to get out. So let's see.
Which recent companies did you buy?
I bought a couple of long-term ones. One of them is Aegis Vopak, which I think is a stock that it's not going to do anything now. I think it's trading around the offer price, maybe 5 rupees higher, which is neither here nor there. But I think it's in a business that's here to stay. And a lot of it will just be decided on what happens in the US. And the president has actually mentioned that anyone who sides with BRICS, we're going to have another 10% tariff. It's not come in yet, but who knows whether it'll come in tomorrow or day after. So I guess the last time I checked, India was part of BRICS, the center eye. So we're going to have some extra tariffs maybe, but let's see.
All right. Hi, Mr. Advani. Good afternoon. Good to see you, Ben. What about IndusInd Bank? What is the call? We were debating about this the last time around, and there's an equally bullish and bearish argument out there. Some would argue about the price to book, and some would argue what is in the book we don't know. What are you making of it?
Well, as I mentioned the last time, the IndusInd Bank is a bit of a trading stock. You trade in and out, either from the long side or the short side. I think the last time I was on your channel, it was around the same price. So I would not have made any money or lost any money since then. But I am, at the moment, not in the stock.
All right, got it. What about the infrastructure theme? That's something that you like, right, in the past?
Yeah, I think that's going to continue. I think that's here to stay. See, I look at infrastructure being a cheaper version of defense, because defense, as Dipin also said, the P's are very high, and it's very difficult for us to sort of traditional market players will look at fundamentals to say, hey, we should buy defense stocks, because they're all. I think the cheapest one is 40x, so it's a tough call. But infra is lower. Infra is also here to stay, and particularly if you're in the construction space, you've got the choice of redevelopments, new construction, RERA projects, roads. The world is your oyster. In fact, one of the companies, I don't remember offhand which one it was, actually mentioned that they don't want to even get into projects unless they can see 20% IRR. So, which means there's a lot more projects and a lot less infrastructure players chasing them. So for them, they can't raise the prices yet too much because everyone's still being very cautious. But the thing is, they've got as much work as they want to do. And I think that's very encouraging for the sector.
Give us some names, Mr. Advani. Jay Kumar is something that you liked. L&T is another one that you've spoken about in the past. Anything from the space?
Those are the ones. I mean, Jay Kumar is doing very well in the road space. But again, I think even the realtors are also, doing their projects. But I think as opposed to real estate, I am more comfortable in infrastructure, simply because I feel that infrastructure is where it's at, because the companies can actually move. The construction people are going to make more money than the real estate people, according to me, in this next cycle.
Okay, all right. So that's a thumbs up on infrastructure players and contractors, and they haven't actually, to be fair, these stocks haven't moved. A lot of other parts of the market like EMS and defense, they've all been soaring, going through the roof. By the way, on a side note, that was important update coming in on Selby Aviation. This was the aftermath of Operation Sindoor, where India had decided to revoke the company's security clearance. And Selby obviously was a major operator at big airports. And then they had gone and challenged that in the courts. And now it seems the Delhi High Court at least has not upheld their pleas. That's important news on a side note. But Pashupati, hi, great listening into you this afternoon. Tariffs and wars aside, market's been actually remarkably resilient. The US market and, of course, even our market. What do you think the second half has in store? I mean, you've given us some pockets like infra where you can still incrementally add. But if you're out of the market, you'll always regret missing. If you're in the market, you're worried about valuation. So tell us some more approaches.
So I think you can't exit the market because India is still you hear from people that India is the bread of the month and the India market is doing fine. But you've also got people from outside saying, how do we make money in this country? And for foreign investors, of course, the funds and all and the insurance companies and the sovereign funds are sorted out. But if you are running a company and you want to try and make money in India, or you are an investor who thinks that they want to invest in India as an individual, it's extremely difficult and cumbersome. So I think that we need to figure out a nice way for people to be able to invest in and out. I mean, people don't want to put their money and get it stuck. And they don't want to go through a mutual fund because the mutual funds charge a lot of money. And there's no Index India mutual fund yet that I know of that is a true index fund like Vanguard is in the US. So I think that, it's a quandary. But people are looking to try and invest in India. But the question is, how? And if you're a true Gora, you can't just walk into a bank and open an account. It doesn't work like that.
Speaking of Goras, there are Goras who walked in, did all kinds of trades, and now they have a tussle ongoing with the market regulator. You've seen, many cycles, Pashupati, but this is something new. The regulator taking on a firm of this magnitude and a firm that had very, very large trading positions. Now, do you see this impacting the market in any way? Maybe immediate volumes, day-to-day volatility, trade, and this is more on the trading side than, of course, fundamental buyers who wouldn't need to bother. Well, do you see any ramifications?
Well, of course, I think that this is a notice to others who are in the same game, and there are plenty of others who do play the same game, to be wary of the Indian regulator. The question is, I hope the Indian regulator is able to claw back some of the gains. I don't know what it'll do with the money once it gets it, but I think that it's worth, shaking them to see if they can give back some of it. I mean, I think they've asked for about 15% or 20% of what they see as
4,800 crores. Yeah, roughly 4,800 crores as of now.
Yeah, so ask for a portion of the gain back.
Yeah.
I mean, if I was, I'm not Jane Street, but if I was Jane Street, I'd probably, make noise and then try to settle with the regulator, because I mean, they do want to be in business here. And but what's to stop a Jane Street becoming? I said to someone, there'll be an April Street next week, or a July Street. So I think that, but our regulator at least has picked up the patterns, albeit late, but they picked up the patterns. It would be nice to see if they could pick it up earlier. And also, I don't know if they're going to be able to get any restitution from any of the brokers who've done the trades, because I don't think Jane Street had a brokerage company. So, I think those guys also need to try and persuade Jane Street to give some money back.
No, there will be there will be some money, in the custody of brokers, because I mean, they were a regular market participant, Pashupati. So that is there, and I imagine that those accounts are frozen.
Well, we'll see. I mean, I haven't heard anything. I mean, I hope you're right, but that I don't think would be a small amount. I mean, that'll be a small amount.
No, it's not a small amount. I think it's very large. That's the whole point, right? With Jane, it was all very large. If it was small, and the capital and the money essentially is what allowed them to do what they did. From what I understand, I mean, it's pretty large. And those accounts perhaps would already have been frozen. But anyway, we'll see as we sort of look ahead at it. But points taken, Pashupati. Thank you very much for joining us.
Thank you.
Good speaking with you. It's always a pleasure. Let's take a quick commercial break here. And as always, we get you a check on what's happening in dealing rooms in our D Street chatter segment. Nimesh is back with us for that. Stay tuned.
Welcome back. A flattish session is what we're seeing today for the Nifty, but plenty happening in the broader markets. That said, it's time for our favorite segment, D Street Chatter. Nimesh is just to help us out with what is he picking up. Nimesh, a quietest day of trade, but plenty happening from the broader markets. How are you reading it?
I think it's largely happening in the FMCG sector stocks, right? That's been the big leader of the pack today. And that's the reason why the Nifty is flat despite, not much happening otherwise in the overall market, so to speak. Even the flows are quite muted. The only space which continues to see buying interest is the PSU basket. And there the sector rotation continues. So again, my sense is there is a bit of buying in select PSU stocks, especially the bank stocks, as well as the OMC. So that's from a flow perspective. But otherwise, it's been pretty much quiet. I guess the market lacks two things. One, important triggers, and also a bit of buying interest from the domestic mutual funds and insurance companies. That's been lacking in the last couple of days. From a trigger point of view, I guess the positive US-India deal could be a big trigger to watch out for. And of course, the earnings season where I guess for Q1 updates, the stocks are reacting as well. So that's something to track in the very near term. But from a flow perspective, it's quite muted with only selective buying in the PSU names.
Okay, all right. What about individual stocks, Nimesh? What are you picking up?
Well, a lot of individual stocks are buzzing in trade. So the first stock on my list is UPL. For the last couple of days, that stock has been buzzing. There has been buying interest back from larger HNIs, is what I understand in UPL. And the general sense is that Q1 could be quite strong as far as earnings are concerned. So that's a trigger there. The second stock is Dixon Technologies. We saw a large block last week where Motilal bought from the promoters. And since then, you've seen a bit of uptick as well in that particular stock. There is a very strong indication that maybe the company is going to announce a big tie-up with a global firm very soon. That's the trigger as far as Dixon is concerned. The third stock is Cyient Limited. Within the IT name, this is relatively underperformed, but I understand a leading domestic PMS has been an active buyer in Cyient of late. Remember, there is a change of guard as well in Cyient. So potentially, what's the strategy going to be? That's going to be key for Cyient in the very near term. And the last is Uptown. We normally don't talk about this stock, but big mover in the last few days. In fact, if you look at the 1 week chart, the stock is almost rallied 35-40%. And again, there is an anticipation of a corporate development in Uptown very soon.
Okay, all right. Nimesh, thanks very much for that. Interesting list of stocks as always. And we'll keep a track of some of these names. Well, I think Mitesh is now with us to run us through what he'd like you to buy or sell today for a reverse trade tomorrow. Mitesh, go on.
Britannia, in fact, the entire FMCG pack is buzzing well, Prashant, today. So I have a Britannia as a BTST. Recommend buying here or with the stock below 58.50 for a target of 59.20 for tomorrow. And CAMS is on the negative side. It's kind of giving a sell signal on the hourly chart. So maybe this will see more pressure. STBT here with the stop at 41.61 for targets of 41.10 or so.
Got that. By the way, just a quick word, if you will, on Equitas Bank. I mean, I don't know if you've tracked this. Big down move, 7% lower today.
I don't track the stock regularly, but yes, today because of that fall, it's come into focus. There is some good support around the 62 to about 61 zone, which is where we had a rising gap on the 12th of May. In case you break that, and there's a good chance of that happening, then I think the stock will decline further and possibly head towards 58.
Anything on Deepak Fertilizers? One-way move and now starting to correct a little bit?
Yeah, again, very extremely overbought stock. I think now is showing first signs of profit booking. The medium-term support is around 1520, 1524. I think that's the target the stock should do, and then maybe we'll see some more.
I see. Got it. More later. Thanks very much, Deepan, for joining us with that. Now, let's shift focus. And this is, of course, the Trump's tariff agenda. Sources tell CNBC-TV18 that India and the US are set to take a final decision on a mini trade deal in the next 2 days. Parishit is here with what he's picking up the latest. Parishit, over to you.
Well, we're expecting a final decision by tonight. President Trump is likely to make that announcement. In fact, sources telling us that whatever negotiations had to happen on the early trade deal are now done. No further talks are taking place, and a political call has to be taken by both President Trump and Prime Minister Narendra Modi. We're also learning from our sources that India has drawn its red lines in the negotiations, that we will not offer any concessions on sensitive areas in agriculture and dairy. This includes wheat, rice, maize, and dairy products and GMO crops as well. So no market access in those areas. On automobile tariffs, we've conveyed that we would like to offer similar tariff arrangements as we've done with the European Union, with the UK as well. There cannot be anything different for the United States. We've been learning from sources that India has offered a fair deal, which would be a win-win for both sides, and would also give good market access for India's labor-intensive sectors such as textiles and footwear. We're told that the tariff deal is likely to be a mix of both quotas and tariffs. So, for example, in labor-intensive tech sectors like textiles and footwear, an annual quota could be set for lower tariffs, and anything that exceeds that could be subject to higher tariffs. But let's first wait and see if a deal happens also, because the US is very insistent that they want lower tariffs in agriculture and dairy sectors. India has said no to that. Let's see in the next few hours if the deal happens, and we're expecting an announcement possibly by late tonight in India.
Okay, all right, got it. Pariksha, thanks very much. So waiting by as the hours tick, and let's see what contour this mini trade agreement or mini trade understanding perhaps finally takes. Thank you for that. Well, we just saw some numbers flash on the general insurance side. So let's see how the data for June is looking like. Yash, what are the early trends indicating?
Well, Surabhi, it's a tale of two extremes. On one hand, there's a sharp decline which has come through for ICICI Lombard. And this is not just in the month of June on a year-on-year basis, but in the month of June on a year-on-year basis, in the month of June on a month-on-month basis, and for the first quarter, as far as ICICI Lombard witnessing that sharp decline in premium collection. The other extreme is New India Assurance, where there's a sharp outperformance which has come as compared to the industry average, not just as compared to, of course, ICICI Lombard, but as compared to the industry average. And this again on a month-on-month basis, year-on-year basis, and for the first quarter. To speak about specific numbers, ICICI Lombard, the June premium is down 8% on a month-on-month basis. On the other hand, industry has seen a growth of 5%. ICICI Lombard in the month of, in the first quarter, the premium has grown by just 1%. The industry premium, on the other hand, has grown by 9% in the same period. Now let's speak about New India Assurance. June premium has grown by 11% versus industry growth of 5%. This is on a year-on-year basis. On a month-on-month basis, June premium has grown by 13%. The industry premium has grown by just 5%. And finally, for the first quarter, New India Assurance, the premium has grown by 15% as compared to industry growth of 9%. So simple headline, ICICI Lombard experiencing a sharp downtick in premium collection on a month-on-month, year-on-year and first quarter basis. Other extreme, New India Assurance seeing a sharp outperformance in its premium collection, again on all three parameters, month-on-month, year-on-year and for the first quarter as compared to industry average.
Thank you very much for that. Sudeep Bandyopadhyay, Group Chairman, IndiTrade Capital, now joins us. Sudeep, any thoughts on the data that's out?
Well, I think it's very difficult, Rima, to interpret from one segment of the data. I think for the general insurance business, the April month becomes very, very critical. So I don't have the April data readily in front of me. So I need to really see what happened in April to understand. Look, June is not a big month for general insurance. April is. So April data is more important. So I don't think we should decide one way or the other about ICICI Lombard or even New India Assurance based on this set of data. That's what my feeling is. Overall, I think in spite of the challenges which the general insurance industry in India is facing and some of the regulatory changes which are happening, I think the growth trajectory is uninterrupted. Overall, the industry is growing at around 5-6%. And I think this growth can significantly go up from here on as well.
No, absolutely. Point taken. Just a quick word. That's the insurance space, and life insurers also have done well. Actually, this year generally broadly has been pretty good. Like in most other sectors, in insurance as well, there is the expectation. SEBI's got a new chief. RBI has got a new chief. IRDAI hopefully will get a piece. I think Yash last week put out a story in terms of who some of the possible candidates, etc. as well. Here as well, we've seen a fair bit of tightening on many accounts. Will we see some relief now? At least that's the street expectation, both for life and for general insurers as well, things like bank assurance, etc. A quick word, on the Dreamfolk stock, if you will, Sudeep. Just a complete collapse from 230, 240 levels to about 178 now.
In fact, Prashant, I did comment, I think last week on this stock, and I advised investors to stay away. It's a falling knife, no point trying to catch it. Yes, they have been talking about, I did see the interview on your channel, and I think they're talking about international business, they're talking about other businesses, but these are all future, but as things stand today, they are in a very, very tricky situation. and things are not at all looking good as things stand today. So it's completely avoidable at this stage. One doesn't know where this fall will stop. It's been continuously falling, and as things stand, I think it's better avoided.
Okay, that's been an avoid. Even last week you indicated that. Stay on. Sudeep, need to get into a break. As we do that, here's some good news for all our viewers, because India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. You can get instant access to all our news, articles, financial world updates at your fingertips. So don't wait. Download the CNBC-TV18 app now from the Apple or the Google Play Store, or you could just scan that QR code on your screen.
Welcome back. Well, markets as flat as can be. Breadth of the market in favor of a number of stocks declining, but stocks are moving around from the broader markets. And one such theme that's playing out is the steel tubes and pipes. You have smaller names like a JTL, Hariom Pipes. They have given volume growth in Q1 of close to around 25 to around 30%. So you see both those two stocks. In fact, JTL, the last couple of trading sessions, you have nearly 1 crore shares that have got traded. Even in Friday, even in today's trading session, volumes are very, very large and it has valuation support. Though the bigger name in there is APL Apollo Tubes. That as well has given you no returns in the last 2 years. Sudeep, what about this space? If there's going to be a big infra boost, a big spend, these companies will be able to deliver volume growth, which was actually lacking in the last few years. And the smaller names are getting it at fairly decent valuations. While the larger name APL Apollo Tubes, on a larger base, growth will be a little lower. What's your view on the space and what do you like?
You are absolutely right, Nigel. I think the opportunity for these companies are significant with the kind of infrastructure spending we are talking about, based on the government's commitment of spending 11 lakh crore during the current fiscal. And the money spending by the central government in the right earnest has already started. So, there will be no dearth of demand or orders for their products. Now, the question is picking up the right stock for getting the right kind of returns. And I think APL Apollo is priced richly, I would say, to an extent. And one needs to be a little careful while buying at these valuations. You can look at some of the smaller names, and you just mentioned JTL. I think, yes, that's probably the reason that these stocks are attracting investors' attention. And a lot of buying is being seen in these stocks. Yes, one can look at buying a stock like JTL, but remember, this is not a very, very short-term game. You have to have, let's say, about a 9 months to 1 year kind of time horizon if you are buying into, let's say, JTL at current levels.
Got that. Sudeep, a quick word on InfoEdge. The Q1 updates came out and growth has slowed down. The overall billings growth is at 11%, and it's down for both recruitment, that's the Naukri business, where billing growth is about 9% versus 18% in the prior quarter, and even for real estate. Now, considering the kind of upheaval the entire job market is going through on account of AI, what are the prospects of InfoEdge? Do you think it's going to disrupt their business greatly?
Well, I think it will be disruptive, and it is being disruptive in the short and medium term. But I think long term, the business is going to remain robust. We will see these kind of slowdown in growth because the volumes are coming down. When it was only pure play IT outsourcing business, the numbers which they were hiring were significantly higher. Whereas in case of AI, the quality of job is much more enriched, but the numbers are not so humongous. So there will be a difference. I'm sure, will fine-tune and adjust to the new reality, and they will start delivering. But this adjustment will take some time, and that's pretty much what we are seeing now.
Okay. By the way, looking at one more pocket beyond FMCG, healthcare, hospitals, diagnostic stocks, they've been doing well. Metropolis, which also came out with its first quarter update, is up 5.5%. Yatharth Hospital is up about 5%. There's Thyrocare, which is up about 6%. We should just get all these stocks in. Apollo Hospitals, anyway, it's far, far bigger name. It was the best winner from last week. Even today, Apollo Hospitals is managing a 1% up move. So, yeah, healthcare always in demand. Sudeep, hi, good afternoon. Do you like anything? Diagnostics, healthcare?
I do like healthcare. I do like the hospitals. And Apollo has been my favorite for last 1.5 year plus. And of course, this demerger, which they're doing now, will definitely make it much more sharper, focused business. And even the business which is getting demerged will get sharper focus and probably a better valuation independently going forward. But as far as diagnostic space is concerned, I'm a little concerned and I'll be a little careful. Yes, the Metropolis numbers I did see, and the numbers were pretty good for the quarter gone by. But I think the competition is going to be much more intense with Amazon announcing their intention to get into this space in a reasonably big way. And beyond Amazon also, I think overall the competition is hotting up. It doesn't take away anything from what Metropolis or Dr. Lal Patlab is doing. But the fact remains that the margins, we believe that in the medium to long term, margins will start coming down, and it will be a low margin, high volume business, and that's what I think the players also have realized to an extent, and that's why they're trying to increase the volume by different different means, including smaller acquisitions, niche acquisitions, like Metropolis has done as far as the oncology space is concerned in the last quarter. So let's see, wait and watch. But at current valuation, I'm a little careful while recommending a buy on the diagnostic space.
Okay, Apollo Hospitals, by the way, 52-week high on the stock today. It hit a level of over 7,600. So it's been a strong move. Just allow us a minute or two as we recap the day, and then we'll come back to you, Sudeep. What a flat day it really has been. Let's pull up the Nifty. Look at the chart. It's all over the place. Red, green, red, green, red, green, and all in a tight, narrow band. Extremely choppy. And finally, we've got a red blink again, 1 point on the lower side. Let's talk about individual stocks. The lower end was being brought up by names like BEL, ONGC. These are stocks on the way down. Tech Mahindra was down about 2% as well. HCL Tech down 1%. Infosys down 1%. So it seems there's some nerves as the IT earnings season kicks off this week. Aside of this, Maruti Suzuki, there's Ultratech Cement, which has lost over 1%. Hero Motors, some of these auto stocks were doing pretty well last week, but they've cooled off today. Financials didn't really help the index. ICICI Bank, for instance, 0.5% lower. Let's look at HDFC Bank, slightly lower on HDFC Bank as well. And SBI was also down about 0.6%. What was up, however? Consumer, and more consumer. Lever, 3%. Tata Consumer, 1.5%. Nestle, over 1%. Asian Paints, long list actually. Eicher Motors actually did well as well. It was bucking the overall weak trend. And then, of course, there's Reliance. The reason why the Nifty did not fall too much is because of the big giants like Lever, ITC, and Reliance, all adding up on the green side today.
Well, the mid-cap index ends with a cut of about 1/3 of a percentage point. Negative advance decline.